Good morning, everyone, in all continents and in all time zones. This is Joseph Trevisani from FX Solutions, and today we're going to talk about Greece and the debt crisis, which has had an enormous, well, from a theatrical point of view, I guess we couldn't have had a better morning for this topic. Chosen, obviously, it is the obvious topic to talk about in almost any financial market these days. And long or short. And with today's news, both from the central banks and yesterday's conference call, kind of wonder what they were talking about between Merkel, Sarkozy, and Papandreou, we have the results that they were looking for in the market. So how can we break this down? I spent a lot of time this morning talking to various reporters and others about what's going on and about how this came about. And this is my thoughts on it. I'll be glad to go through. That's actually what I'm going to go through today. From the very beginning of this debt crisis 2 years ago, well, at least when it became obvious, there has really only been two choices. Either the Germans pay or Greece defaults. That has not changed. Let us think for a second about the progression of the European attitudes, the official European attitudes, towards the Greek problem, the Greek debt problem. Originally, if we go back to Greece's entry into the euro, we now know that the government in Greece, to put it politely, fudged their books so that they could meet the standards that were set out, the strict standards that were set out for joining the euro. It has always seemed incredible to me that the other European governments did not know that the Greeks were fudging their books, that they were essentially lying about the status of their economy, about the tax collections, and all the rest of the standards or the criteria that were part. So from the very beginning, the Europeans have ignored their own considerations, their own economic and financial considerations, to promote the overall goal, and it's not just the overall goal of the euro or the ERM, it's the overall goal that they have been pursuing since the Second World War, and that is European unification. Next, how should I put it, not quite betrayal, but next line in the sand, forgive me for the cliche, that the Europeans lost. And that, of course, was the 3% deficit limit of the Maastricht Treaty. When it was necessary to get rid of that, they got rid of that. Next one that I can think of at the moment, the ECB was not supposed to buy sovereign debt. Gone. The last one, the one that we're facing right now, the bailout of last year of Greece, had various terms in it that they had to meet. Deficit reduction, along those lines. Greece has met none of them. Well, they may have met one or two. But they haven't met all of them, and they were supposed to meet all of them. That is what's holding up, or at least that's what's causing speculation, that maybe they won't get the next disbursement from the first bailout. Don't worry about it. Greece will get the bailout. They will get the money. Quite a number of things I've read. The Greek government has enough money to keep paying its bills. I'm not talking about redemptions of bonds or interest payments on bonds. It's domestic bills, pensions, things like that, for a few more weeks. If they don't get this disbursement from the first bailout, Greece will not be able to pay its domestic bill. The effect on the financial markets around the world will be the same as if they had not made an interest payment on a bond. So the idea that the Europeans are not going to give Greece this money is preposterous. If I have to get up here in a few weeks and the IMF and the rest of the lenders have actually said, no, you haven't met the terms, you can't have the money, maybe I'll leave my shirt live. I'll hook up a webcam and do that, because I just don't believe that's going to happen. So right from the very beginning of it'll be a T-shirt or maybe a tank top. I mean, it's going to be a small shirt. I'm not going to have a long sleeve shirt here with French cuffs. I don't think I could do that. But enough on that. So from the very beginning of the euro, there has been both deceit and betrayal of their own standards in pursuit of this greater goal. Here we are, stuck in the middle of a political and economic, the ends justify the means situation. And that's what we have. No, not a single one of the standards that were put in place, many at the insistence of the Germans, to protect the EU, by default, of course, the ERM, and the nations of Europe from defaulters, from cheaters, from malfeasance, from people and countries that aren't living up to the standards of the euro, have failed. And so here we are. The goal has overridden everything. So that's sort of the background on, my last name is Trevisani, so my family is from southern Italy, so I'm very much a part of it. So from the beginning, there has been a very serious disconnect. Let's not say disconnect. Let's say willing suspension of belief, of critical facilities. A dog, as they say in the cliche, doesn't change its, or is it a leopard? A leopard, as they say, doesn't change its spots. And we are looking at a very serious case of a leopard not changing its spots. The Germans are not Greeks, the Greeks are not Germans, and neither is any other of the cultures in Europe without meaning. They have meaning. They do describe national characteristics. Now, we are not going to do an essay or a lecture on comparative cultural values here, or comparative cultural traits. That's not our purpose. But after all, what we're talking about is based in the different experiences, the different cultures, if you will, the different languages, the different ways of looking at the world, exhibited by the national units, which are also largely, in Europe, cultural units. Okay. Let us move on from that. So today's action by the central banks. What did it mean, and why did they do it? One of the most crucial facts or crucial events in the financial crisis of late 2008 and into 2009, but primarily late 2008, was how close the world financial system came to freezing up. Banks lend to each other their excess reserves in the overnight, the week market, in the money market. Banks borrow overnight so that they meet the standards of capital adequacy set down by governments and other institutions. But banks have no guarantee from the other bank that they'll get the money back. I remember very, very well when I was on a trading desk and we were looking for lines for various, actually, for those of you in the market may remember the name Revco. And what happened to them? Well, we were looking for lines because banks do deals and trade and lend money to each other without collateral. It's not like a bank lending money to a homeowner to buy a house. If they don't pay the loan, the bank repossesses the house. The bank may not want to, but it nevertheless has collateral. Banks don't lend to each other based on collateral. They lend to each other based on credit assessments. I worked for Credit Suisse, one of the three large Swiss banks. Well, actually, there are two now. And we wanted to do currency trades with REFCO. Now, banks who judge each other's, and there's a credit committee that you have to get through that will give you the amount of limit that you can trade with another bank, depending on the committee's judgment of this bank's creditworthiness. So if we were dealing with Chase, it used to be Chase in those days, we may have had a 300 or 400 million or maybe even more limit of position size that we could have open with Chase on a 2-day settlement for foreign exchange positions. For REFCO, after a year of requests from the trading desk, from my trading desk, the credit committee of Credit Suisse gave us a $500,000 limit. That's it. Why? Because they didn't think REFCO was creditworthy. It was not a bank. It was a trading organization. There are lots of good reasons for this. But that is how banks judge whether or not they're going to lend and how much they're going to lend to another bank. Not just in outstanding positions in the foreign exchange market, but this also applies to overnight lending, the money markets. What has been going on in Europe over the past several weeks is that American banks and even European banks have become increasingly reluctant to lend overnight and with short-term durations to other European banks. They're also charging more. So that is the symptom, and it's the same symptom from the financial crisis. Because when banks don't lend to each other, it doesn't change the necessity for the bank to have a certain amount of capital on hand. These are the rules. And if they don't have the capital on hand, they have to get it from someplace. The only place left is the classic role of a central bank as the lender of last resort. And that is precisely what the world central banks were doing today. And it's not that the financial system is anywhere near the frozen or semi-frozen status of the fall of 2008, but that it was headed in that direction. This is a role that central banks are designed for. It's one they do well, and it's one that they're effective at. It is far different than what the American Fed is trying to do by goosing equity markets to provide some sort of benefit to the economy so people will spend more with all of their QE and everything else they've done. Yes, exactly right. Providing liquidity to the private banking system. That is the classic role of a central bank. This goes back to the beginnings of central banks. That was their original role. They have morphed into many other things, as we've seen, but that is the classic role of a central bank, and that's exactly what these banks are doing now. The money markets are a symptom. They're not the cause. Just as in the fall of I'm looking at CNBC, and Christine Lagarde is on right now with Maria Bartiromo. I can't listen to it, but I'd be interested to see what you have to say. In the fall of 2008, the problem was absolutely analogous. The instruments were different, but the situation was the same. Banks could not judge the creditworthiness of their counterparties. In that case, it was because, that's interesting. Let me just make one comment on that, on what Mr. Volcker says. Is that the real Paul Volcker? I'd be very honored if it was. The European view, of course. No. All right, let me answer these two questions, then go on. It's very interesting that she said this is the difference between the Europeans and the Americans. And it's very, very odd that you have this split, because it's usually the reverse. Usually it's the Americans who are far more free market and saying you have to let the market work itself out. The Europeans in this case are taking that role. They're saying the problem is that the banks, there's simply been too much lending in the markets, and that has to stop. And that is the basic problem. The Americans are now saying, under the Obama administration and Mr. Geithner, that there's not enough money. In my case, I would look at the empirical facts that we've seen. The Fed has poured trillions into the U.S. economy. It has not revived the economy. That tells me that the problem with the U.S. economy and the world economy is not a lack of liquidity. It's a lack of desire to use that liquidity. So in this case, I would come down with the European analysis, where they are restricting, where they are attempting to control their deficits, and where they have cut budgets all across the continent. Now, part of it is because many of these countries, such as Greece and the others, simply can't get any money to borrow to keep running their country, and the people who might lend it to them are demanding, either backed by the Germans or the private credit market, are demanding, as bondholders always do, we're not interested so much in the economy, we're interested in getting our money back. So, cut your deficits so that you can provide the money to the bondholders. That's sort of a classic credit market way of dealing with the problem. In this case, because of the facts that we've seen over the past several years, I would actually come down, as I said, on the European side. Because we do have the fact that all this liquidity and incredibly low interest rates, historically low interest rates, have not revived the U.S. economy. They haven't revived the housing market. They haven't revived the job market, because it's not the problem. Okay, next one. No liquidity. The money in the system hasn't gone anywhere. What's happening is that banks are not lending it. They're keeping it on their books because they're worried about the future. So they keep it on their balance sheet. They may put it at the Fed where they get minuscule interest rates. They could get more from lending it in the money market, but they're worried about the future. They're worried about the stability of the European banks. They're worried about their credit worthiness. They're worried about their own liquidity needs for the future. Same with corporations. The money hasn't gone anywhere, but it's not being used. Sort of in the old-fashioned term from when I was in grad school, the velocity of money has collapsed. It's not going anywhere. So that's where the money is. Okay. So the money markets that we have seen from the reluctance of the increasing reluctance of banks and other institutions to lend to European banks is the symptom. As the problem was in the fall of 2008 with all of the asset-backed securities, nobody knew what they were worth. Nobody knew what the valuation was. Nobody really knew how many of them were on any bank's books, so nobody wanted to lend to anybody. Same thing here. They know, more or less now, what each bank has, but they're concerned about whether or not Greece, and of course if Greece defaults, it is absolutely Pandora's box when it comes to the European banking system and the world financial system. The interconnections of the world financial system, as we have seen from 2008. Remember, in the summer of 2008, Mr. Trichet saying, basically, we have no problem here with subprime. Not quite. Same thing now. And I don't think anyone is fooling themselves now, as the Europeans apparently did in the summer of, at least the ECB did in the summer of 2008 when they raised rates, right before the Great Collapse. Right before the greatest financial crisis since the Depression, the Europeans are raising rates. So I don't think anyone's fooling themselves anymore, as apparently they were fooling themselves a little more than 3 years ago. So the problem for the European banking system and the world banking system is that if Greece defaults, all of these banks, or many of them, will have enormous holes in their balance sheets. Like I said earlier, there are rules. The rules stipulate how much you have to have on deposit against your various assets. Because after all, the sovereign debt bonds are assets on the bank's balance sheets. They're assets on a balance sheet and also as far as income goes. But right now, it's more important as far as their value as assets, what they're actually worth. So if Greece defaults, and what was truly frightening the markets were the talk out of Germany, not Angela Merkel herself, but some other politicians, that maybe it's better to let Greece default. With that driving the markets and the fear for the financial system, I'll deal with what I think happens with Greek default, what I think happens if Greece defaults in a minute. Because that, after all, is the original topic of this talk. So the symptom that told both yesterday, that prompted, I think, both yesterday's call and certainly today's action was the withdrawal of liquidity, progressive, from the European banks. Because that was telling the bank managers, the regulators, and the politicians that the system was starting to freeze. And so that is what prompted yesterday's call. After all, Merkel, Sarkozy, and Papandreou didn't say anything new. They didn't propose any new programs. They didn't say there was going to be any more money. They didn't say anything, really, except to reassure the markets that, and this is the only purpose of that call, that Greece was not going to leave, that the Germans were still behind Greek continuation in the EMU and in the EU. It's my contention that if Greece left the EMU, they would soon be out of the EU as well. But that's another topic, and we'll deal with it in a few minutes. It had been the speculation that the Germans were going to permit Greece to default that drove this entire 2 or 3 week semi-crisis or mini-crisis within the overall debt crisis. So the purpose of the call yesterday was to reassure the markets that Germany was not going to let the Greeks default. And why do I say Germany? Because Germany is paying the bills. Yes, the IMF may have lent, and the ES, the European Stability Facility may, but basically it's the Germans who pay. As I said earlier, there have only been 2 options from the very beginning of this crisis. The Europeans and everyone, all the other politicians and everyone else in public eye is pretending there were 3. There are really only 2. The reason Germany is against Eurobonds because it's exactly the problem that led to us in the first place. Only it would be official in that case. The reason Greece got into this trouble is because once they joined the euro, they were able to borrow at German rates, essentially. If German 10-year bonds were paying, I don't know what they're paying, 2, 2.5, they're right now at 1.7. But say they were paying 2.5, 3% when the euro 5 years ago. I'd have to check. I don't know what it is. Greece could borrow only a little bit higher than that. Well, Greece's own financial condition justified nothing like that. But Greece borrowed all this money. Now it can't pay it back because it was a member of the euro. The assumption of the markets was exactly what's happened. And it was a genuine assumption. Turned out to be true. Germany is going to backstop them, which is what's happened. So from a market point of view, from a credit point of view, the correct assumptions were made that the Greeks can borrow at German rates even though they're Greece because the Germans are going to pay for it anyway. That's what's happened. Eurobonds will do exactly the same thing unless they have some sort of special designation to separate out, in which case it doesn't achieve what they're trying to do, which is, of course, get Greece back into the market. Eurobonds will be backed by all of the countries of the EU. Okay, that's great. What good is a bond backed by Greece? We already know. Nothing. What good is a bond backed by Portugal? A little bit better. Ireland, a little better than that. Italy, a little better than that. Spain, maybe. So you have exactly the same issue. The credit of Germany and France and Belgium and a few others, I know the Nordic countries, I want to talk about it, are backing the Eurobond. So it's exactly that. And this is why Germany doesn't want to do it. That's why France doesn't want to do it. Because they will, and all of the rates in Germany, and the rates that the Germans are going to have to pay to borrow into national markets on the Eurobonds are going to go up. Because now that the market's alerted to this problem, Eurobonds are not going to be the same as German bonds. Germany can borrow 10 years at like 1.7 or 1.8 the last I checked. The U.S. is a little over 2 today. It went back up, of course. Well, those are not going to be the rates of Eurobonds. So among other things, it's going to cost the German taxpayer a lot more money because they're going to have to pay higher rates. So that's why Germany and France are against this. Okay, so where were we? Oh, liquidity. Okay, so the money markets were the symptom. They both prompted the call yesterday because the underlying problem has not changed. It's that Greece can't pay its bills, and it's not going to. Yeah, I've been to Athens many, many times over the past couple of years, and there are some beautiful roads in and around Athens. And I asked them, I said, Greece is supposed to be out of money. And yes, they built a beautiful highway from Athens to the airport. It's great. Get there in like 20 minutes. I mean, it's really cool once you finally get out of Athens, which is an older city. But it was built with EU money, as with many of the other things. I've been on these fantastic roads in Sicily, elevated highways across the center of the island. Absolutely beautiful. Nobody on the roads. Marvelous views built with EU money. So yes, there is this serious issue with who's getting the money and what they're doing with it. Now, you can certainly make the argument that this kind of infrastructure construction over the long run is okay. I'm not going to answer any conspiracy theories here. Sorry, folks. You guys will have to consult with each other on those. Anyway, so the problem was with the money markets. That's the symptom, but it's a symptom of the basic problem, which is these countries are never going to be pay back their debts. I don't see any potential for Greece to pay back its debt. It would seem to me, and I've said this from the very beginning of this problem, or at least the very beginning of the public notice of this problem, that there must be a write-down at some point. And there are two problems with that. One, of course, is the banking problem, which is what we're dealing with here today. That can be backstopped, as we've seen today. Now, the reason I think it hasn't happened is, one, it costs a lot of money, and two, if banks started amassing reserves, it would indicate to the markets, perhaps, one, that governments are forcing this, and two, that somebody here is expecting a Greek default. The bigger problem, I think, is for Europe, for certainly the politicians, for the bureaucrats, for the ruling elites in Europe, the idea of a unification, of a unified Europe, is one that has no competitor in the sense of the future. Meaning, they don't really see any other possibility for the future of Europe. Given Europe's history in the 20th century, that is a completely understandable view. But that doesn't mean it's a realistic view. As with the cliche about generals and the military. They're always preparing for the last war. It's my sense that that is the situation here as well. Europe itself is essentially demilitarized. There isn't really any sense in my mind. Now, these things become generational, meaning that it took the better part of a generation for the First World War to be forgotten and for the Second World War to become close. From 1918 until 1939, that's 21 years. Not quite a generation if you take it in the traditional sense of 30 years. So even though now it seems utterly inconceivable of a remilitarized Europe, that doesn't mean it wouldn't be conceivable in a generation or in 20 years, especially if the intervening time is spent in the turmoil and economic decline like you saw in the 1930s. So, just because it doesn't seem possible now doesn't mean it's not possible. So although we would look, and I could say easily that the unified Europe, politically, financially, economically, yes, I'd agree with that. I would never believe that history repeats itself in that sense. And I understand exactly what you're saying about Latvia and Russia. But again, that's a different topic. And I'm trying not to do too much on the politics because that's a never-ending topic and it's not really our topic here. But the idea of a unified Europe is one which has very much ruled. Oh no, nothing at all. There's nothing to apologize for, please. There's nothing that anyone can say here that I think is inappropriate. I just don't have enough time to cover everything and answer all the questions and sort of pontificate and lecture on the entire history of Europe, and I probably don't know enough to do it anyway. But the idea of a unified Europe is one which has ruled political planning and economic planning in Europe since the Second World War. And as I said earlier, it's very understandable why. It doesn't necessarily mean that it's the best plan. It's the best plan, I think, to prevent an outbreak of World War II again. Yes, that I agree with. But that doesn't mean that that is the likely occurrence in the future. So, but it is the one that's on tap. Now, the problem that the Europeans are having is twofold. One, that it may have been the best that they could do at the time in the political reality of it, but it is insufficient. And there is no longer a way around it. I'll talk about the dollar reserve currency in a second. Then I'll talk, it's 38 already, so we're going to have to not go too much longer. So I'll cover two more topics. I'll certainly talk about the dollar and what I think is going to happen with the currency. Anyway, let me finish one topic at a time. I know I jump around a lot. Sorry about that. On today's action by the central banks, I think it was coordinated in time with yesterday's announcement, with yesterday's call by the. I'd be glad to do much more, but we have time limits here. It was coordinated, I'm pretty sure, with the conference call yesterday. The Europeans know, we know, everybody knows that this is a twofold problem, and that the money markets was a symptom of the underlying problem, which is the confidence of what's going to happen with Greek debt. So they took a two-step approach, and I guarantee you there was consultation between today's announcement by the central bank and yesterday's call and announcement and backing that Greece is going to stay in the euro by the Germans, the French, and Papandreou. The basic problem they dealt with yesterday. We're going to stay behind the Greeks. The Greeks are going to stay in the EMU. Yesterday's call. Markets started to move yesterday. Today they come out and dealt with the symptom, which of course was the money markets. There we have the type of thing that government does well. Fidel Castro used to speak for like 5 hours when he was a young man, when he was my age. Now he's a little bit older and he's not doing so well. But he used to give like 5-hour talks. I don't know how anybody could do that. Anyway. So this is the kind of thing that governments do well, and they just look at the markets today. Although I think you're going to get the initial effect is going to remain strongest in the equities, and the reason is because the liquidity problem that was driving the equities has been dealt with, and the reason they did it for 3 months is because they want to give the markets time to calm down. They don't want this problem to come back. You can already go to the ECB and get weak money, meaning money for a week. Now they're letting banks get money for 3 months. And that's why, because that will, then the markets will know, the equities markets and the money markets will know that these banks are not going to be short of liquidity on a 3-month rolling basis because they've got 3 dates stretching out till December. So you're talking all the way till the end of the first quarter next year where these banks can get enough money if they need it. So that's why they did this. Okay. The problem that the other markets are seeing. Now, the equities are going to buy this one. They know that there isn't going to be a problem with SocGen for 3 months, for 6 months, whatever it is. Stocks will rise. I mean, SocGen, I think, is up 15% today. The other markets are going to be a little less reluctant, a little more reluctant to participate in this as strenuously. And the reason is because the basic problem hasn't been dealt with yet. And the basic problem cannot be dealt with. What? As I said earlier, there were only ever from the beginning of this problem. Yeah, I think the ECB borrowed from the Fed. Now, the Fed put in swap lines. I'm actually not a specialist in the money market, so I can't tell you exactly what they did. But yes, the Fed lends money to the ECB. They do a swap for euros. I'm not exactly sure how they do it. The Fed did this during the financial crisis in 2008. They put out these enormous swap lines. I think that's what it is. I'll read some more today so that next time somebody asks me, I'll know. Thank God none of the reporters who asked me about that today. I actually had to tell one of the reporters I didn't actually know because I didn't. The Chinese are publicity seekers in my estimation. They did this about a year ago when the Greeks were having their initial problems. China suddenly flew onto the scene, said that, they would consider lending Greece money. They never did it. They're not going to do it now either. They don't have to. But they are getting some free publicity from this. So yes, the ECB lent them, they're doing it in Finland. So anyway, there originally there are really only 2 solutions to this, but the politicians have pretended there were 3. The 2 that I believed in is either the Germans pay or default. The politicians, understandably, not wanting to deal with either one of those, and neither one of them is really politically feasible, have pretended there's a third possibility, and that is that you fund these countries until their economies pick up so that they can reduce their deficits and start to pay down their debt. That is the third possibility, the third way. But the third way is not realistic. If you look at what's happening in Greece, the economy is collapsing. It's contracting 4 and 5% a year. There is no way that Greece can pay back this debt. Period. But it's not going to be dealt with right now. Certainly there is the idea, and this is credible, that whatever the solution of this problem is, and I think any politician in Europe, if you get them, do they drink? I think Europeans like their politicians to drink more than Americans do. At any rate, probably a gross generalization. I have spent a good deal of time in Europe, though. Would realize, although they can't say it in public, that the only way out of this for Greece to default and start over again. But now is probably not the best time for that to happen. And that's a credible response. Now is probably not the best time for that to happen. However, politicians and others and the bureaucrats can never really find the best time for bad things to happen. So the only way to get bad things done is when there is a great deal of pressure from a poor economy to do it, at any rate. So that's the issues that are being dealt with on the Greek side. The problem right now and why the Europeans cannot let Greece default is because it would immediately cause an enormous problem for the world financial system. If you're going to write down Greece 50%, then what else are you going to write down? Well, you're probably going to write down Portugal. Ireland, maybe yes, maybe no, I'm not sure. I've been told by several people whose opinions I trust that Ireland is actually doing a pretty good job about handling this problem. But Ireland's problem is not an uncompetitive economy in the world. Ireland has a very competitive economy. They had a bad banking crisis and a property crisis, but it's not an uncompetitive economy. Greece is an uncompetitive economy. Portugal is an uncompetitive economy. Italy is fast becoming an uncompetitive economy despite some of its world-renowned products. The growth of the Italian economy over the past 10 years has averaged like 0.1% per year. You can't pay down debt like that. Spain has a very similar problem. So Ireland is kind of the outlier in this. They do have a competitive economy. The other ones don't. And without a competitive economy, the U.S. has managed in a different situation because the U.S., and this is a true worry here now, the U.S. growth has averaged close to 3% over, I think, the past generation. I'd have to check the actual numbers. At 3%, you can get away with the type of debt that until this current administration had been amassed. But if the growth goes down, if the growth goes down to 2% or 1.5%, the way it has been in Greece and many of the other countries in Europe, then you can't get away with this, and the markets won't let you. Although, of course, the U.S. does have the advantage of the world reserve currency. Okay, so that is the situation we have today, I think, relating to the central banks. It's absolutely fascinating to watch this plays out. You know, it appears to be very complicated and secret, but really it's not. The decisions that are made are macro decisions. They are based on the types of things that are readily accessible and readily understandable for almost everyone who participates in the currency markets, or even if they don't participate but simply follow politics and economics around the world. These are not trying to come up and explain some algorithm for a trading program. These are macro political items, trends, and decisions, and they are readily understandable by everyone. Okay. If anyone has any specific questions on this topic, the ostensible topic of today's talk, please type them in, and I will do my best to answer them. I will be glad to answer any questions and stay a little bit longer. So let me just read what my original idea was for today's speaker and for today's talk, and that is, I'll just read it to you. I called it Endgame. What are the implications of a Greek default? Ignore the protests and promises of the Athens government. Believe the credit markets. There is no way out for the Greek government, the Euro, or the European Union except restructuring. I still believe that. It will not be immediate. At the very least, Germany and France will want time to prepare their banks and the continental financial system for the coming write-down, but it will happen. I said initially before the end of the year. I'm not so sure about that now. The crucial countries are, as they have been throughout this crisis, Spain and Italy. If they are priced out of the credit markets, the path through default becomes much more dangerous, and the future of the EU and the Euro, and I say this with all due humility to everyone on the webinar from Europe. I am not saying this from any pinnacle of superiority from the United States. That's certainly true. But it really does call the future of the Euro and probably the EU into question. At least it will do enormous damage to the idea of an ever-increasing political and financial unity within Europe. And this has been the motivating goal. And if there are any Europeans on the call who disagree with this, I don't mean that they don't think it's a good idea. I mean that they don't think that the European governments and the European ruling classes, does classes work, have taken this as a goal, except perhaps for the British. Please chime in and let me know. So, what are the implications? It is quite possible that the union can't be undone. That's probably true. But the idea of an ever closer union can be. And that, I think, is the fear for most of Europe. And this is on top of the very, very real fear that a Greek default would throw every country in Europe, I think, into recession just about. And probably the world with it as well. The amount of turmoil that would be engendered by that, the drop in even the even the moderate amounts of lending and access to credit markets going on now, would be such that I can't, and the world economy itself is very weak right now anyway, including the Chinese, that I don't think you'd be able to avoid a very, very deep and nasty recession. So, that's a very real problem. And that's something which any government, any central bank is beholden to try and avoid. Okay, so what would be the results of a Greek default? We're actually seeing that right now. We spoke about the money markets and the banks and the financial system. But let's take a step back. The results of a Greek default, or even a Greek failure to pay some of its domestic bills, which I alluded to earlier, would result in write-downs for much European debt. It would also, I think, cause a tremendous rise in the dollar. People would flood to the dollar. I've maintained throughout this that even when people were supposedly going to the Swiss franc as a safe haven, I said, yeah, that's true. They're doing it now because there's not that much tension in the world. Switzerland's a small country. When things get ugly, and if they do get ugly again, they will again flock to the dollar, and we've seen that. If you look at what's been going on in the euro, I have the chart right here. I don't do charts very much, as you know. 8.29, the euro was at 145.47 as a high. 8.29, 2 weeks ago. The bottom was yesterday at 4.98. It's almost an 11-figure, a 10.5-figure fall in 2 weeks. That is telling you what remains the world reserve currency and the world safe haven currency and the world safe haven nation. It's not Switzerland. It's the United States. And that is not going to change. There just isn't any, no matter how profligate our government is, there isn't any place to go. You can't buy yuan. It's not a freely traded currency. And if you, let's put it politely, that the Chinese government is not terribly transparent. And you don't have a lot of input as to what the Chinese government might or might not do. So there really is no alternative. And that's what we've seen in the past 2 weeks. An absolute flood to the dollar. Where else are they going to go? Okay, so until Mars is unified and has a better government than governments here, that's going to remain. So that is back to the Greek default. The first problem with a Greek default is that it would cause a write-down for. Let me just answer that question. The problem with U.S. debt is a problem of growth. The debt is a problem, in my mind, the problem of U.S. debt is a problem of spending and not of taxation. But the credibility, the sustainability of U.S. debt is a problem of economic growth, not of the debt, even at its current level. Because if the U.S. economy grows 3.5% for long term, you are one going to get slightly higher inflation, which will by itself diminish the debt, and two, if you can get that kind of growth, and there's no reason you can't get that kind of growth, the U.S. has demonstrated that over and over again, given the proper policies, and you hold the line on debt, then yes. So for the U.S., I don't think that's as big a problem because the U.S. remains an enormously competitive economy. If you look at the major industries of the past 20 years, computers, it's driven both software and initially hardware by the U.S. Look at the most desirable consumer product in the world right now. They're all produced by Apple, at least in the computer field. So I don't think there's a problem of U.S. competitiveness. I'm actually not going to comment on the administration. It doesn't actually matter in my mind who the U.S. owes its debt to. What matters is the sustainability of the debt and the amount of growth that the U.S. economy exhibits over a long period. That's the key in my mind. And the biggest problem we're having right now is that there's no potential for growth. The U.S. economy is not growing. We can discuss at another time the reasons for that. But that's the biggest problem right now. So the biggest problem with Greek debt is that a Greek default or a Greek cessation of payments domestically would immediately, see, it's not just Greece that would get written down, and that would cause enormous amounts of worry throughout the world financial system, primarily Europe. It's everybody else. Greece is just the canary in the coal mine, the poster child, the founder of Western democracy. And don't forget, Greek democracy lasted about what? About 200 years, 250 years. Domestically, it lasted through the Romans, when the Romans took over which I think is about 150. In foreign affairs, it ended about 200 years before that, when Macedonia really took over the foreign relations of most. That's true. That's caught. You're absolutely right. But what I meant was that the Greek city-states, Athens and Sparta and Corinth and all of the others, had totally independent policies, both domestically and with each other, until Philip and Alexander defeated them at Chaeronea, which I think was about 330, 335. I'm not exactly sure when. Actually, that was Chaeronea, I think was Alexander. At any rate, so at that point, the Greeks became part of the Macedonian, not quite empire, but the Macedonians actually controlled their foreign policy largely. So, yes, the Greeks are Macedonians, Macedonians are Greeks. Yes, that's true. But say Athens lost sort of its independent foreign policy, as did Sparta, as did Corinth, as did the rest of them during that time. Now, a lot of those cities had been allied with Macedonia before that. However, forgive me for my departure into ancient Greek history, but it is actually fascinating. A lot of parallels. That's why everybody keeps studying it. Anyway, problem with Greek debt is that it would any cessation of payment domestically or failure to pay internationally would immediately cause an enormous write-down in many other countries' debt. Certainly Portugal, certainly Ireland, regardless of Ireland's success currently, it would still be caught in this. It would also cause write-downs in Italian and Spanish debt. It would probably start on France. Most of those countries might then be frozen out of the world credit markets. If the European Stability Facility can fund Greece, Portugal, and Ireland, it cannot. Certainly, factually, right now, under the current capitalization of this facility, it cannot support Italy and Spain. And they would no doubt require support were this to happen. So that's the key. And then, of course, you go on to the problem that we have today, or that was dealt with today by the central banks. The money markets, the financial system, the turnover that never is meaningful until it doesn't turn over of day-to-day funding of the world financial system. All banks would have exposure to this. Maybe the Central Bank of Mongolia does not. And I don't pick on Mongolia, I just don't think that they're terribly connected to the world financial system. I could be wrong about that. If there anyone from Mongolia out there, please let me know if I'm incorrect. So the problems are not localized. They're global. And they would cause a cascade of problems throughout the financial system. And they will not stop, meaning that no one really knows, just as with the bankruptcy of Lehman, and that is a worthwhile analogy, as certainly as it plays through the world financial system, that there were unseen consequences. There will be. This is a system which, although it is regulated by governments, has been the subject of much study. It is also an organic system, meaning it largely grew up, evolved on its own. And the connections and the potential for unseen damage is absolutely enormous. Although it may be emotionally satisfying, certainly for the Germans and others who are paying for others' profligacy, and for people who don't believe in fiat currencies and many, many other things, to look upon this and say it is just desserts and proper comeuppance, I'm not sure that any of us would really want to live through, or the risk. After all, we have children, we have families, we have girlfriends and boyfriends, and we have people that we care about. I'm not going to get maudlin here. No, it's not so much that Greece's default is catastrophic. You're absolutely right. Its participation in the EU and the EMU is tiny. It's that a Greek default will cause many, many other things to happen. Remember, a financial system is based on assumptions. Assumptions of creditworthiness. No, it didn't. It didn't, but you're absolutely right about that. And Russia defaulted also. So I think you're probably right that the default of Greece would be less damaging than the concern about it. But when you combine that with the damage that the Greek default would do to the European ideal of an ever closer union, you have the answer as to why the Europeans are so stringently attempting to prevent it. So it's twofold. It is the default. Don't forget, Argentina, nobody wanted to help them anymore. They defaulted. And people saw it coming a long time. Russia was a bit of a surprise. It did not crash the U.S. economy. It did not crash the economy. However, because of the degree, not of Greek debt, but of the European sovereign debt of the countries that I mentioned throughout the world banking system, it's actually a much bigger problem because of that. Okay, folks, I think I should probably cease. I thank you all for coming. Okay, let me just answer that question. You know, these things are often, when you try and think these things through, you must automatically go to worst case. And the world has had a long time, the world financial system has had more than 2 years to prepare for something which seems blindingly obvious is probably going to happen at some point. So in that sense, they're probably, European banks are probably better prepared, and the world financial system is probably better prepared. If you're looking for a reason why there is so much capital sitting on bank and company balance sheets, this is one. This is one of the reasons. The second reason is, of course, because there's no real growth out there in the world, and no corporations at least are convinced that this is a good time to spend any money to hire people or to create new production facilities or anything like that, because they don't see any demand coming in. So the two work in tandem, both for companies and for banks, to retain money. It's defensive, but when they look at the future, they say, hey, defense is a good idea to do today. So yes, I'm not a specialist in this. I'm actually not a specialist in anything except maybe currencies. But an interesting comparison would be, and you're absolutely correct, to the extent of the debt of Argentina, which defaulted 28 years ago, I saw this recently, and Russia, which defaulted 13 years ago, on the extent of the holdings of the world banking system. Now, don't forget, 28 years ago, that's a generation. There was, guess what, no internet. Basically, 13 years ago, there was no internet. So the degree of interconnection in the world, and this is a very important factor, is far greater now than it was then. So that means that it's just a whole lot easier for banks and everybody else to buy debt or to seek return overseas. They can now do it with a computer. Flip, goes over there. It's very, very different. So that's one factor. The other factor is that I'm not sure how widely held and how extensive Argentine and Russian debt was during their two defaults. Because we're not here just talking about Greek debt. We're talking about Greek debt, Portuguese debt, Irish debt, Italian debt, and Spanish debt. That's a lot of debt. That's several trillions at least in outstanding debt that might have to be written down. So just on that factor, this, I think, although again I don't have the figures, is a far greater problem than Argentina 28 years ago or Russia 13 years ago. Let me see about this. Could the French and Germans get their idea of a transaction tax, and what would be the implication for retail traders? I doubt that tax would extend down to retail traders, but I'm not really sure about that. The tax, I think, was it on all finance? I don't actually know. I remember hearing about it. I don't know if it was a transaction tax on all financial transactions. Does that mean if you pay your barber, that's a financial transaction? Or it was, I don't pay my barber very much. You probably know that if you've seen my picture. Or whether it was simply on large-scale transactions between banks. I don't know that. Okay, 2 sentences, and this will be the last thing. Let me ask these 2 questions, then I'll stop. You mean the credit default swaps? Yes, European banks hold a great deal of Greek debt and a great deal of European debt as well. The other countries that I mentioned. I don't know actually who's writing the CDS. Those are credit default swaps. That's the insurance that banks pay. It is a private, unregulated transaction. There's no exchange. As far as I know, there are very little rules for it. This is how AIG got into trouble. It wrote all of these CDS, all the CDS paper on the mortgage market without any collateral for it. It's essentially an insurance policy. And they didn't put any collateral behind it because nobody was regulating them. So that's the problem with CDS. I don't know who's writing CDS policies these days. I'm sure it's all the major money center banks. You're not going to get, Valley National Bank here in Bergen County writing CDS policies. It's the money center banks. So, the ones you think about, the big French banks, the big British banks, the big American banks, and probably some banks around the world as well. Germany gets cheap money because it is viewed as a very creditworthy economy. Its exports are huge. Its productivity is huge. The demand for its products are huge. As soon as a country gets a lot of money, it starts buying Mercedes. Although I did hear that Maserati is bringing out an SUV. We'll all have to look into that. It looked nice in 2013. And because it has a low deficit relative to world deficits. That's why people are willing to lend, and because it's Germany. Cultural values. And that's why the world, the credit markets, individuals are willing to lend Germany at low rates. They know they're going to get their money back. A Eurobond would hurt them because it would incorporate all of the countries in Europe, in the EMU, many of which are not creditworthy. Greece, Portugal, Ireland, to some degree Italy and Spain. So the Eurobond, at which rate, so that lack of creditworthiness on those countries would be incorporated into the rates. Well, if you're not as creditworthy, you have to pay more to borrow money, which is why the Greek 2-year rate is, 50%? Because nobody thinks that they're going to pay it back, or at least the risk is enormous. So if Germany is part of a euro bond, then it will have to borrow at those rates. The rates will necessarily incorporate the less creditworthiness of some of the other countries in the EMU. So instead of getting 2-year money at whatever it is now, 1.8, I think, it would be some other much higher rate because of that. No, it's too early in the morning for me to have a beer, but I thank you very much for the compliment. I do not expect QE3 to happen. I think the Fed will probably do some other program at the next FOMC. I don't think it'll be effective. QE, as I said earlier, the Fed's been pouring liquidity into the economy. When you pour liquidity into the banking system to prevent a collapse, which is what TARP did, even though it's much reviled, and what the central banks did today, that's one thing. But when you pour liquidity into an economy to spur growth, and you don't get growth, it means, yes, Germany is the second value exporter in the world. It was until, I think, a few months ago, maybe 6 or 8 months ago, by value, the greatest exporter in the world. That means that Germany, a country of 70 or 80 million people, exported more value products than China. China has now taken over. A country of, 1.3 billion people? Tells you something about the quality and the desirability of German products. Now, there are many products in the U.S. that are exactly the same. So that's why, with different policies, I would not be concerned as much about U.S. potential for economic growth. Okay, I thank you all very much for staying. I hope this was interesting. The next time we're all in Barcelona, I'll be glad to accept many beers. I thank you very much, and I wish everyone a great day. Take care. Take care, everybody. Bye-bye.